Imagine for a second that a distant relative, let's call him Uncle Scrooge, leaves you an inheritance. After taxes, the cheque clears for exactly $100,000. It is sitting in your checking account right now. You know you need to invest it for your retirement, but you are staring at the market and it looks shaky. Do you take that entire $100,000 and dump it into the S&P 500 today, all at once? Or do you play it safe and drip feed the money in, maybe $10,000 a month for 10 months, just in case the market crashes next week? This is the classic battle, lump sum versus dollar cost averaging. And I'm going to be honest with you, your intuition on which one is safer is probably wrong. In fact, the data tells us that one of these strategies is mathematically superior roughly 66% of the time. If you pick the wrong one, you aren't just losing time, you are voluntarily handing over returns that you didn't have to sacrifice. I see this debate tear people apart in comment sections and financial forums constantly. One camp screams that putting all your money in at once is reckless gambling. The other camp yells that holding cash is a guaranteed loss due to inflation. Today, we are not going to yell. We are going to look at 80 years of data from the US, the UK, and Australia to settle this. We are going to look at the landmark research from Vanguard, studies from PWL Capital, and the math behind why markets move the way they do. But more importantly, we are going to talk about why you might choose the mathematically wrong option on purpose, and why that might actually be the smartest thing you can do for your sanity. We are going to visualize the difference between optimizing for a spreadsheet and optimizing for a good night's sleep. Because sometimes, paying a little insurance premium in the form of lower returns is worth it to keep you from panicking. Before we dive into the spreadsheets, I have a small request. If you want to stop guessing with your money and start using data to make decisions, that is exactly what we do here. Subscribing to the channel is probably the best return on investment you will get on your time today, and it costs you $0. So go ahead and click that button, and let's get into the mechanics. The first thing we have to do is clearly define what we are actually talking about, because a lot of people misuse the term dollar cost averaging. They think it just means investing from their paycheck every 2 weeks. That is not what we are discussing today. That is just regular investing. The debate only exists when you have a pile of cash sitting there right now and you have to make a choice. All in now or slowly over time. Let's stick with our example. You have that $100,000 lump sum. Option A is the lump sum approach. You log into your brokerage account, you buy your index funds, and you are fully invested by lunchtime. You are 100% exposed to the market immediately. Option B is dollar cost averaging, or DCA. You decide that $10,000 a month feels safer. You invest the first $10,000 today, and you leave $90,000 sitting in cash or a money market fund. Next month, you move another $10,000. You do this until the cash is gone. The theory here, the myth we tell ourselves, is that by waiting, we are buying insurance against a crash. If the market drops 20% next month, the lump sum investor is crying. But the DCA investor? They are actually happy because their next $10,000 installment buys more shares at a cheaper price. It feels like a win-win. You participate if it goes up, but you get a discount if it goes down. It sounds prudent. It sounds responsible. But there is a hidden cost here that most people completely ignore. The hidden cost is something called cash drag. When you choose to drip feed your money into the market over 12 months, that means, on average, half of your money is sitting on the sidelines for that entire year. While that money is sitting there, it is not earning the equity risk premium. That's the fancy term for the returns stocks pay you for taking on risk. Historically, the stock market goes up more often than it goes down. By keeping your money in cash, you are betting against the house. You are betting that the market will fall or stay flat. If the market does what it usually does, which is slowly drift upward, you are buying in at higher and higher prices every single month. You aren't getting a discount, you are paying a penalty for waiting. The math is brutal here. Every day that cash sits uninvested, it is losing purchasing power to inflation and losing opportunity cost to the market. So while DCA feels like insurance, it is actually a very expensive form of market timing. You are timing the market by saying, I think it might be better to buy later than to buy now. Here is why this is so hard to grasp. Our brains are wired to fear loss twice as much as we value gain. This is called loss aversion. When you hold that 100 grand, you feel a massive responsibility to protect it. The idea of investing it at 10 a.m. and watching the market drop 2% by 4 p.m. makes you physically nauseous. So DCA feels right because it minimises potential regret. It is a painkiller. If the market drops, you feel like a genius because you still have cash to deploy. If the market goes up, you don't feel too bad because you at least invested some of it. It flatters our emotional state. But investing isn't about feeling good, it's about growing wealth. And by optimizing for your feelings, you are mathematically choosing to have less money in the future. The data doesn't care about your regret, it only looks at the prices. And this brings us to the big study that proves just how much this emotional safety blanket costs you. So we have the theory. Lump sum maximizes time in the market, while DCA minimizes regret but creates cash drag. But theories are cheap. We need hard evidence. Fortunately, Vanguard, the guys who basically invented low-cost index investing, did the heavy lifting for us. They published a massive paper titled Invest Now or Temporarily Hold Your Cash. They didn't just look at a few lucky years. They ran simulations across the US, the UK and Australia going back to 1926. They looked at 100% stock portfolios and they looked at balanced 60-40 portfolios. They tested rolling 10-year periods. The results were not ambiguous. They were overwhelming. And before I tell you the exact number, ask yourself, how often do you think the market actually beats cash? Because that is the real question. You might be thinking, okay, Tom, so maybe I lose 1% or 2% by waiting. Who cares? Better safe than sorry. But wait, it gets worse. It's not just about missing out on a little bit of profit. The data shows that the longer you wait, the worse the odds get. This isn't just a coin flip. If you delay investing because you are waiting for the perfect moment, you are fighting a statistical gravity that is pulling prices up. The longer you sit in cash, the more likely you are to end up panic buying at a much higher price later. Let's look at the actual win rate. Here is the headline number from the Vanguard study. Lump sum investing outperformed dollar cost averaging roughly 66% of the time. 2/3 of the time. That holds true whether you are looking at the United States, the United Kingdom, or Australia. If you had a lump sum and you invested it all immediately, you ended up with more money after 10 years than if you had dripped it in over 12 months. And this wasn't a small margin. On average, the lump sum portfolio value was about 2.3% higher than the DCA portfolio in the US. Now, 2.3% might not sound like a life-changing number, but remember, that is the average. In strong bull markets, the difference was much wider. Essentially, by choosing to DCA, you are walking into a casino where the house wins 66% of the time, and you are betting on the underdog. You are betting that this specific year will be one of the rare bad ones. Statistically, that is a losing bet. You might be wondering if this only applies to aggressive stock portfolios. Maybe if you are conservative, DCA works better? Vanguard checked that too. They ran the numbers for a 100% equity portfolio and a balanced portfolio of 60% stocks and 40% bonds. The result? Lump sum still won roughly 2/3 of the time. In fact, for the 60/40 portfolio, lump sum outperformed DCA about 67% of the time in the US. The consistency here is frightening. It basically suggests that asset allocation doesn't change the fundamental rule. Markets generally trend upward. Even when they looked at shorter rolling periods, like investing over 6 months versus 36 months, lump sum maintained its lead. Forbes even cited data showing that over a 36-month period, lump sum beat DCA a staggering 92% of the time. That is because 36 months is a long time to have cash sitting on the sidelines earning nothing. The longer you drag out the process, the more returns you are likely sacrificing. Let's look at the distribution of outcomes, because averages can lie. Maybe lump sum wins on average, but when it loses, it destroys you? Vanguard looked at the percentiles. At the 50th percentile, the median outcome, lump sum is clearly ahead. But what about the worst-case scenarios? In the worst 5% of historical periods, we are talking about investing right before the Great Depression or the global financial crisis, DCA did come out ahead. But not by as much as you'd think. In those terrible scenarios, DCA beat lump sum, but usually only by a few percentage points. However, look at the upside. In the best 5% of scenarios, when markets rip upward, lump sum crushed DCA by a massive margin. So the trade-off is this. With DCA, you are cutting off your potential upside significantly, just to slightly buffer the downside in the very rare worst-case events. You are paying a very expensive premium for a policy that rarely pays out. This isn't just a US phenomenon. The study covered the UK and Australia specifically to ensure this wasn't just a result of the American economic engine. In the UK, lump sum won about 68% of the time. In Australia, it was roughly 70%. The logic holds up globally because the logic is based on the nature of capitalism. Companies generate profits. Profits drive stock prices. Over long periods, that drive is upward. If you are in a market that trends down for 50 years, you have bigger problems than DCA versus lump sum. You have a failed state. Assuming you are investing in a functioning economy, the math dictates that you want your capital working for you as soon as possible. But I know what you are thinking. Tom, what about that other 34% of the time? What if I am the unlucky one? Most people stop the analysis here and say, okay, 66% odds are good, I'll go all in. But this is where conventional wisdom trips you up. Winning 66% of the time means you lose 34% of the time. That is 1 out of every 3 investors. If you walked into a doctor's office and they said, this surgery works, but 1 out of 3 patients loses a leg, you would hesitate. We need to talk about that 34%. Because if you happen to be in that unlucky minority, the math doesn't matter. What matters is if you panic and sell at the bottom. The math says lump sum is better, but human nature says we need to survive the 34%. Let's be real about when DCA actually wins. Dollar cost averaging wins when the market falls immediately after you start investing and stays down for a while. It shines in a bear market. If you had a lump sum in March of 2000, right at the peak of the dot-com bubble, and you shoved it all into the Nasdaq, you would have been crushed. You would have lost a massive chunk of your wealth, and it would have taken years to recover. In that specific scenario, DCA would have been a savior. By buying slowly as the market crashed, you would have lowered your average cost per share. Morningstar ran the numbers on this. From March 2000 to October 2002, a lump sum into equities would have lost nearly 14% annualized. DCA would have limited that loss to under 2%. That is a huge difference in psychological damage. In this specific case, DCA acted exactly like the insurance policy it claims to be. This is what financial nerds call sequence of returns risk. It's the risk that the specific order of investment returns hurts you, even if the long-term average is fine. If you retire or invest a lump sum right before a crash, your portfolio value drops, and it is terrifying. DCA smooths out that entry sequence. It takes the luck out of the timing. Instead of one entry point, you have 12 or 24 entry points. The average of those entry points will likely be closer to the market average. You will never buy at the absolute bottom, but you will also never buy everything at the absolute top. You are choosing mediocrity to avoid catastrophe. And for the 34% of history where the market went sideways or down, mediocrity was a blessing. It preserved capital when aggressive investors were getting wiped out. But here is the twist. We don't have a crystal ball. You don't know if you are in 1999, about to crash, or 2013, about to roar higher. If you choose to DCA because you are afraid of 1999, you risk missing out on 2013, 2014, 2015, and so on. However, we have to respect the behavioural side. If you lump sum invest and the market drops 10% the next week, will you sell? Be honest. If the answer is yes, or even maybe, then lump sum is dangerous for you. Not because of the math, but because of your behaviour. If you panic sell at the bottom, you turn a temporary paper loss into a permanent real loss. That is the worst possible outcome. In this sense, DCA is a fee you pay to keep yourself from doing something stupid. It is a behavioural hedge. You are paying potential returns in exchange for confidence. And for many people, that confidence is what allows them to stay invested for the long haul. Think of it this way. In math land, lump sum is the clear winner. In human land, the best strategy is the one you can stick with. If DCA helps you sleep at night, do it. But, and this is a big but, you have to admit what you are doing. You are not being smarter than the market. You are buying emotional insurance. And like any insurance, it has a cost. The cost is the likely underperformance compared to lump sum. If you are okay with that cost, then proceed. But don't delude yourself into thinking you are mathematically optimizing. You are behaviorally optimizing. There is a difference. The goal is to get the money invested. If fear paralyzes you into keeping that $100,000 in a savings account for 5 years, that is the worst outcome of all. If DCA is the trick that gets you to click buy, then use the trick. Just understand the price of admission. We are about to get to the specific protocol, exactly how long you should DCA if you choose that route. But first, there is a secret leak in the DCA strategy that nobody talks about. It's the forever trap. I've seen people say they are going to DCA, but then they stop halfway through because the market went up and they don't want to buy at the top. Or the market went down and they want to wait for the bottom. If you don't automate this, you aren't dollar cost averaging. You are just procrastinating with extra steps. Here is the strict rule you need to follow. If you decide to go the lump sum route, the execution is simple but terrifying. You log in, you place the order, and then, this is crucial, you close the tab, and you do not look at it for 6 months. Seriously, delete the app from your phone if you have to. You have made a statistical bet based on 80 years of data. Don't micromanage it based on Tuesday's news. However, if you decide to DCA, you need a rigid contract with yourself. You cannot wing it. You need to define the total amount, the frequency, and the duration. For example, $120,000 total, invested as $20,000 on the first of every month for 6 months. Once you set that plan, it must be automated. You do not get to wake up on the first and see how the market feels. That is market timing, and you will fail at it. The whole point of DCA is to remove emotion. If you reinsert emotion by manually deciding each trade, you have defeated the purpose. How long should your DCA window be? This is where people mess up. They drag it out over 2 or 3 years. That is too long. The data suggests that if you are going to DCA, you should keep the window relatively short, typically 6 to 12 months. Any longer than 12 months, and the cash drag becomes so severe that you are almost guaranteeing underperformance. Remember, the market trends up. The longer you wait, the higher the prices usually go. A 6-month DCA window strikes a nice balance. It gives you enough time to smooth out a sudden crash, but it gets your money fully invested quickly enough to capture the long-term compounding. If you are sitting on cash right now, make a plan to have it fully deployed within 6 months. No excuses. There is a third option that I rarely see discussed, but I love it. It's the hybrid approach. Let's say you have that $100K. You are too scared to lump sum, but you know DCA is statistically costly. Why not split the difference? Lump sum 50% of it immediately. Put $50K in the market today. Then DCA the remaining $50K over the next 6 months. This gives you half the exposure immediately, capturing some of that expected return, while keeping half in reserve to satisfy your psychological need for safety. If the market goes up, you're glad you put half in. If the market goes down, you're glad you have half left to buy cheaper. It is the ultimate have your cake and eat it too strategy for the indecisive investor. It stops the paralysis. So, who wins? Mathematically, lump sum. It wins 66% of the time. It generates higher expected wealth. It is the rational choice for a robot. Psychologically, dollar cost averaging. It reduces the variance of outcomes. It prevents catastrophic regret. It is the rational choice for a nervous human. You have to decide which one you are. Are you a robot, or are you a human who might panic? There is no shame in admitting you are human. The only shame is in staying in cash forever because you are paralyzed by the choice. Pick one. Write the plan down. Execute it. The market is leaving the station, and you want to be on that train, whether you jump on all at once or climb on one limb at a time. I hope this cleared up the noise around this topic. It really comes down to self-awareness. I have personally used both. When I was younger and had less to lose, I lump summed everything. As I've gotten older and the numbers have gotten bigger, I find myself leaning more toward short-term DCA, just for peace of mind. And I am okay with paying that price. The key is that I know I am paying it. I am not tricking myself into thinking it is the better investment strategy. It is just a comfortable one. And comfort has value. If you have ever been burned by a lump sum at the wrong time, or if you have a DCA horror story where you sat in cash while the market rallied 50%, let me know in the comments. I want to see the real-world data from you guys. We can do our own little peer review down there. And if you found this breakdown helpful, if it saved you from analysis paralysis, hit that like button so YouTube shows it to other people who are stuck in cash. Thanks for watching, and I will see you in the next one.